Good evening and welcome to the second episode of the new series of The Summit Investor. I'm Bruce Whitfield. The Effective Investor, it's a brand new book on the shelves right now. It's authored by a man called Franco Busetti, who's got 25 years of investment market experience. There are 5 parts to the book. We don't have time to dig into all 5 parts to do it proper justice, but some key areas that to mention are the principles of investing, a section which looks at why things don't always go according to plan, and boy, don't they always. And then a section on investor psychology, which is always a fascinating topic. Joining us to discuss the book is Franco Busetti himself, and it's good to see you, Franco. You took, 14 weeks out of your life, you worked 12 hours a day, and you've come up with something of a Bible. Can I call it a Bible on investing? It's heavily detailed. It's tough.
That would make it a bit more authoritative than markets allow one to be.
But certainly, you've got this book. It's got a green shoot on the front. Does that exemplify what your view is on markets? Do you see the green shoots?
That was purely coincidental, and a quip I've heard recently was eat green shoots and leave.
Maybe you should. And that's certainly a good sentiment for the markets at the moment. But lots of books have been written on investment. And last week, we had Warren Ingram from Galileo Capital on the program. And he was saying the only book you need to read is the one by Benjamin Graham. And I see you've quoted Benjamin Graham in your own book. Maybe it's a slightly updated 21st century version of the same theme.
Yes, no, he really set the fundamentals for long-term value investing, and that has been proven to be an approach that has worked consistently over time.
Are you, by nature, a value investor?
I have become one, but a cautious one. You know, one of the traps in value investing is buying stuff that becomes a value trap and becomes cheaper and cheaper and cheaper, and I have been caught that way, and I think that's something one has to be very careful about. It's not as if all value stocks outperform. Some outperform spectacularly and compensate for the failures.
But when you say you've become a value investor, were you somewhat more adventurous in your investing style?
I think in my early days I was more of a momentum investor, you know, where one would tend to follow trends. It's in fact a contradiction in term. I think momentum is not an investment style, it's a trading style. So we've been quite careful in the book to distinguish between short-term trading and long-term investment. The book's about long-term investment.
Has it changed your own view on investment? Actually sitting down and going, I need to write a guide for other people on how to do this properly. I've got 25 years of experience, I've had successes, I've made mistakes. Now I'm going to encapsulate that into a tome. Has it changed your own view?
It hasn't changed it, but it's crystallized it. And that was one of the the reasons for writing the book, was to in fact clear my mind of this accumulated baggage of 25 years. It's quite amazing, you know, some techniques work for a short while, then don't. Others work for a long period and then eventually also don't. The markets keep evolving and the rules keep changing slightly, and there are very few that remain consistent over the long term, and those are the ones I've tried to pick out and focus on.
Now, I've dipped into the book and I've gone through the various chapters, and what I like about it, I don't know if you've ever read Thomas Pakenham's The Boer War, but you can pick up Thomas Pakenham's book at almost any chapter and you get something from it, and certainly I get a sense that that's the way this book is designed.
Very much so. You can dip into it at any point. In fact, I'd recommend you start towards the end in part 5, which is aimed at the individual investor, and it's one of the more fun parts of it, and perhaps the most pertinent in many ways, building on what came before.
It can be quite intimidating when you pick up a book and you're new to investing, and a lot of people, the most common question I get is, how do I start? And you effectively tell us how to start at the back. So by starting at the back and then working through to the front, you develop a perspective, I guess, on the investment process.
Yes, if you start at the conclusions and then work backwards to satisfy you about yourself about the logic behind it. What we've tried to do as well to make it even more easy is, after each chapter at the end, there's a grayed out box which summarizes the insight. So even if you might get lost a little bit within the chapter, that'll tell you what the outcome is and what to do.
If investing can be summarized like that, why is it that each generation gets it so horribly wrong and creates a crisis of its own making, do you think?
Well, first of all, we're human beings. We have psychological aberrations that tend to encourage this. Secondly, we have short memories. In the South African market, prior to this crisis, only half our fund managers had in fact been around since 2002. So half of our so-called professionals had not seen nasty market events like in 1998, 1987. So memory keeps being eroded, so you insure yourself a good crash every 10 years or so. In fact, the frequency is increasing. And the third fact really is that by their nature, markets tend to encourage the excess of emotion, the euphoria and negative sentiment at opposite ends of the scale.
Now, if the frequency of crises is increasing, and we had them on average every 10 years, and now computerization, the speed of information, the way in which markets move, there's a lot more volatility in markets than there perhaps ever was because of those factors. Can one invest through crises? And I guess that goes back to the principles of value investing, not getting caught up in the hype and sticking to those principles.
You certainly can. The ideal, of course, is to take advantage of crises because they are golden opportunities. In fact, they are the times when one should be most active. But having said that, if you don't do that, then you should hang in there, generally as a rule, in that if you take a long enough view, you will see good returns over the long term if you ride out these bubbles and crashes.
When one looks at the concept of investing and psychology of investing, you dedicate an entire chapter to it as well. It is understanding the psychology of the herd, which separates, I guess, successful investors. And you've got two very long-term successful investors who've contributed to the book, Dave Ford, and of course Rowan William Short as well, in there as well. Similar philosophies too.
Yes. You know, it's knowing about the psychology doesn't make it easier. In fact, there's another good phrase that it's in fact the title of a book that was written in the UK saying, simple but not easy. And
yes.
That summarizes that, answers your question in effect, that the principles are simple but implementation is quite difficult. And on the psychology, even knowing about it doesn't always help you. It's like optical illusions. Knowing about them doesn't make them go away.
True.
But at least you can see danger signs and know what's going on, and then try and fight it out within yourself and resist the siren calls of what everybody else is doing, which at the peaks is obviously the wrong thing.
And the most extraordinary phenomenon linking psychology to investing as well is when markets peak, everybody wants to get in. As they bottom, everybody wants to get out. We've seen a similar phenomenon now, although people are talking about going back into markets, there's a reluctance to go back to markets post-crisis, or maybe we're in the middle of a crisis.
Yes, look, obviously we've been hurt and there's still a little bit of shell shock, but if you look at the market now, and I'm speaking about the South African market, it's at a level which looks like fair value more or less, and which should in turn ensure normal or reasonably good returns from here out over again a longish period of some years. So in that sense, while there's still some risk, we're obviously closely coupled with the US. If they take another downward leg, we'll tend to follow despite our fundamentals, which look reasonable. Despite that, I think, despite that risk, you can fairly comfortably invest in our equity market at this stage.
And the bottom line of investing is managing your own expectations. Surely that is the core of any investment.
Well, exactly. Not doing that results in the success of Ponzi schemes.
Absolutely, and that's the risk. And people do, unfortunately, get caught up in those sorts of things all the time. The Effective Investor, it's by Franco Busetti. It is a chunky book, and you might be intimidated when you pick it up the first time. You see lots of graphs, but take a moment. Do take a moment and have a good look at it. It looks like a very useful addition to the lessons on investing. Thanks for watching, and thanks to Franco Busetti for coming in. Till next time, bye-bye.
Looking for an investment that pays dividends in the long term? New Nivea for Men D&Age Anti-Age Moisturizer. Nivea for Men. What men want.